Okay, so you want to own a self-storage facility. On paper, it looks like the closest thing to a perfect business that real estate has ever produced. You buy a piece of land on the edge of town. You put up a few rows of metal buildings divided into small units, and then you wait. No servers to seat, no inventory to stock, no product that spoils, breaks, or goes out of style. You do not need a chef, a sales floor, or a fleet of trucks. You need a fence, a gate code, and a website. Rent comes in on the first of the month, whether or not anyone ever opens the unit door again. It is the version of real estate that people describe, almost enviously, as mailbox money. Here is what that picture leaves out. The land you buy is often the cheapest, most awkward parcel in town, the kind no one else wants, and the reason it is cheap is usually the reason it is hard to build on. The construction bill does not stop at steel and concrete. It includes paving, drainage, fire suppression, security systems, and code requirements that vary by county and can add hundreds of thousands of dollars before a single unit is rented. The revenue that looks so steady is, in reality, built almost entirely on a bet about human behavior, not a bet about storage. And the industry that looks recession-proof has, in just the last few years, gone through a supply glut severe enough to knock national rents down year over year and shave roughly a quarter off facility values in some markets from their post-pandemic peak. The building looks like a warehouse. The business underneath it is something closer to a behavioral bet dressed up as a real estate asset. Self-storage does not really sell space. It sells the gap between what people intend to do with their belongings and what they actually do. This is the story of what you are actually buying when you buy that gap, what it costs to build the machine that collects on it, why the machine can print extraordinary margins for years, and why the very same machine can turn on its owner in a matter of quarters when too many other people notice how good the returns look. What you are buying, first, is not really storage capacity. It is a claim on procrastination. Every unit rented at a self-storage facility begins with an intention. I will only need this for a few months, until the move is done, until the divorce is settled, until the estate is sorted, until I find a bigger apartment. That intention is almost always sincere. It is also, statistically, almost always wrong. Once belongings go into a unit, the psychological cost of dealing with them rises, and the financial cost of ignoring them falls to the level of a forgettable line item on a bank statement. A tenant who intended to stay 3 months frequently stays 3 years. That gap between stated intention and actual duration is the single most important variable in the entire business, more important than location, more important than climate control, more important than the design of the building itself. There is a second thing you are buying, and it depends heavily on which version of this business you choose. A small, independently owned facility in a secondary market is buying local monopoly power over a 5-mile radius where zoning makes it nearly impossible for a competitor to build nearby. A large, institutionally managed facility owned by a public storage REIT is buying something closer to a data platform, dynamic pricing software, a national brand that ranks at the top of search results, and a portfolio large enough to absorb the bad luck of any single property. A facility in a dense urban core is buying scarcity, since land there is too expensive for anyone to build a competing project easily. A facility on the outskirts of a fast-growing Sunbelt suburb is buying growth, and, as this story is about to show, growth is exactly what quietly poisoned this business for the better part of 3 years, starting in 2022. Before any of that generates a dollar, you have to build it. And this is where the fantasy of a low-cost, low-effort asset starts to run into arithmetic. Direct construction costs for storage facilities in the United States regularly run into the hundreds of millions of dollars in aggregate spending each year, and on a per-project basis. A modern climate-controlled facility with a few hundred units and paved access, security cameras, keypad gates, and fire code compliance can run well into 7 figures before the first tenant signs a lease. Land acquisition adds another variable that depends entirely on location. Cheap acreage far from rooftops keeps the entry price low, but also keeps demand low, while land close enough to dense housing to guarantee tenants is priced accordingly. Then there is the permitting and entitlement process, which in many municipalities has grown slower and more expensive as local governments have pushed back against self-storage developments that generate little foot traffic, few jobs, and, from a city planner's point of view, not much tax revenue relative to the land they occupy. And then there is the part that almost never appears in the glossy investment brochure: the lease-up period. A newly built facility does not open at full occupancy. It opens empty, and it can take 2 to 4 years to climb toward the 80 to 90% occupancy that operators treat as the real break-even point. During that stretch, the debt service on construction loans keeps arriving every month regardless of how many units are filled. Multiply a modest per-unit construction cost by several hundred units, add years of debt service before the property stabilizes, and the number that looked almost trivially small in a single-unit brochure becomes, at the facility level, a multi-million-dollar bet on a lease-up curve that the owner does not fully control. Here is where it gets interesting, because once the facility is built and filled, the machine that actually makes the money looks nothing like the machine the public imagines. People assume self-storage revenue comes from a stable base of long-term tenants, paying a fixed monthly rate, the way an apartment building collects rent under a year-long lease. It does not work that way, and the difference is the industry's real engine. Most self-storage tenants sign month-to-month agreements, not year-long leases. That single structural choice is what makes the entire business model work, and it works through a mechanism the industry calls existing customer rate increases, or ECRI. New customers are advertised the lowest possible rate to win the sale, often discounted well below the true market rate, because acquiring a first-time renter is the hardest and most price-sensitive part of the transaction. Once that tenant has moved boxes in, hung a lock on the door, and mentally filed the unit away as handled, the facility begins raising that tenant's rate on a recurring schedule, frequently every 6 to 12 months, by amounts that would trigger real anger in almost any other consumer category. Tenants rarely leave over these increases, not because they cannot afford them, but because the cost of renting a truck, taking a day off work, and physically moving a unit's worth of belongings to a cheaper competitor across town is almost always higher than the increase itself. The industry has effectively built a business where the newest, cheapest customers subsidize the marketing funnel, and the oldest, least price-sensitive customers subsidize the profit margin. This is why self-storage is, at its core, a business that monetizes inertia rather than a business that monetizes storage capacity. That mechanism, combined with a cost structure that is almost eerily light, is what produces margins that look implausible next to almost any other type of commercial property. Because most facilities can be run with minimal or even no on-site staff, using remote check-in kiosks and app-based access, labor costs on average run to only a small single-digit percentage of revenue. There is no perishable inventory, no complex mechanical systems beyond basic climate control in premium units, and comparatively little wear and tear from tenants who visit their unit a handful of times a year, if that. Industry-wide data consistently puts self-storage net operating income margins in a range that most other commercial real estate categories can only dream about, often cited between roughly 40 and 70% of revenue depending on the operator's scale and market, compared with an average profit margin across all industries generally cited in the low 20s. At the largest, most efficient publicly traded operators, margins have at times pushed toward the higher end of that range, aided by scale, software-driven pricing, and centralized management that spreads overhead across hundreds of properties at once. But margins that high do not mean the money simply flows in without resistance. The costs that never stop in this business are unusual precisely because they are so quiet. Property taxes are one of the largest single-line items, and self-storage facilities collectively pay billions of dollars annually in property taxes to local governments. A bill that arrives whether occupancy is 95% or 60%. Insurance premiums have climbed steadily across commercial real estate broadly, and storage facilities, which sit on large footprints of relatively low-value structures full of other people's unverified possessions, carry their own particular liability exposure. Management fees, whether paid to an in-house team or a third-party operator, typically consume roughly a third of total operating expenses at facilities that use professional management. And underneath all of it sits the debt. Self-storage development is overwhelmingly financed with borrowed capital, and interest expense alone has been shown, in analyses of tax filings from tens of thousands of small storage operators, to consume something in the range of 9% of annual revenue even before any of the other operating costs are paid. That detail matters because it explains one of the strangest facts in the entire industry. Studies of small, independently owned self-storage sole proprietorships have found their average net profit margin, after debt service and all expenses, sitting at a surprisingly thin 2%, even while the same facilities post an EBITDA margin north of 30%. The gap between those two numbers, roughly 30 points, is almost entirely explained by debt and depreciation. The property looks enormously profitable on an operating basis. The owner who financed it can still be making almost nothing after the bank is paid, which is the first hint of the deeper truth this story is building toward. To see the machine at the smallest possible scale, look at a single 10 by 10 unit, the most common size in the industry. Say that unit rents, in a moderately competitive suburban market, for roughly $130 a month once it is filled, a number well within the range operators typically advertise for that size. Multiply by 12 months, and that single unit generates on the order of $1,500 a year in gross revenue. Direct operating costs allocated to that one unit, its share of property tax, insurance, utilities, and minimal staffing, might run somewhere around $500 to $600 a year at a well-run facility, leaving an operating profit in the neighborhood of $900 to $1,000. A margin comfortably in that 60 to 70% range the industry likes to advertise. Now allocate that unit's share of construction debt, perhaps $15,000 to $20,000 of the total project cost. Once land, paving, and shared infrastructure are divided across every unit in the facility, financed at a commercial mortgage rate. The annual debt service on that share alone can consume several $100s of the operating profit before the owner sees a cent. Multiply that single unit by 300 or 400 to build out a full facility, and the arithmetic scales in both directions at once. The gross revenue becomes meaningful, several $100,000 a year. But so does the debt service, and so does the exposure to a swing in occupancy. Drop occupancy from 90% to 75%, which sounds like a modest, survivable change. And because the fixed costs and the debt service do not move, That 15-point occupancy swing can erase most or all of the property's actual cash profit. This is the sensitivity that the glossy brochure never shows, and it is exactly the sensitivity that turned into a real national event, starting in 2023. Now follow the chain, because this is where the good year and the bad year stop being a hypothetical exercise and start being a documented case study. Coming out of the pandemic, self-storage demand surged. Households were moving at unusually high rates, downsizing, relocating to the Sun Belt, and shifting more of their lives into fewer square feet of living space while pushing the overflow into storage. Occupancy and rents both climbed to records, and investors noticed. Capital poured into new construction at a pace the industry had never seen. Mini-storage construction spending in the United States rose from roughly $4.2 billion in 2021 to about $7.4 billion in 2023, a nearly 1,500% increase over the prior decade of building activity. Every one of those new facilities takes 2 to 3 years to plan, permit, and build, which means the projects greenlit during the 2021 boom were still opening their doors in 2023 and 2024, arriving right as the migration wave that justified building them in the first place began to slow. Then the demand side reversed. Population growth nationally slowed to its weakest pace since the pandemic. State-to-state migration hit a 12-year low. Net inflows into Florida fell more than 90% from their 2022 peak, and Texas, Georgia, and Arizona each saw their migration gains cut by more than half. The exact markets that had attracted the heaviest wave of new construction, the Sun Belt metros, were the same markets where the demand engine that justified that construction was now stalling. New supply kept delivering into a market that had stopped growing at the pace developers had underwritten. Occupancy in those markets fell. To defend occupancy, operators cut advertised move-in rates aggressively, in some cases down to levels not seen in over a decade, which pulled move-in volume back up, but at meaningfully lower revenue per unit. National same-store revenue growth across the sector went negative for the first time in years. Same-store net operating income at some of the largest operators fell by mid-single-digit percentages year over year, driven by that combination of falling revenue and rising operating expenses that would not go away just because rent checks got smaller. Facility values, priced off that shrinking net operating income, fell by an estimated 25% from their post-pandemic peak over roughly 3 years of repricing. Owners who had financed new construction at 2021-era rate assumptions, expecting the boom to continue, found themselves trying to refinance loans against a property earning meaningfully less than the pro forma the original loan was underwritten on, at a moment when interest rates themselves had also risen. That is the failure chain in full. A migration surge triggers a construction boom. The construction boom takes years to deliver. The underlying migration driver fades before the new supply finishes arriving. Occupancy softens in the newly overbuilt markets. Operators cut rates to defend occupancy. Revenue per unit falls faster than expenses. Net operating income compresses, asset values reprice downward, and any owner who financed at boom-era assumptions is left refinancing a smaller, less profitable property into a more expensive lending environment. The most instructive part of this story is not that the industry collapsed, because it did not. What actually happened is a consolidation, and it shows exactly who was positioned to survive a downturn that looked, from a renter's or a driving past the building's perspective, almost invisible. The largest public storage operators, the real estate investment trusts trading on public markets, absorbed the downturn without existential damage, because their scale let them spread the pain of any single overbuilt submarket across a national portfolio. Their balance sheets carried far less leverage than a typical small operator's construction loan, and their access to capital markets meant they were never forced to refinance on distressed terms. Some of the largest operators used the downturn as an acquisition opportunity, buying up struggling smaller operators and newly built but underperforming facilities at prices reset by the very oversupply that had hurt the sellers. Meanwhile, private and smaller operators, who typically carried higher leverage and lacked the geographic diversification to offset a bad Sun Belt submarket with a good Northeast one, felt the occupancy and rate declines far more sharply, with private and CMBS-financed assets running several points of occupancy behind their REIT-owned counterparts, even at the low point of the cycle. This is where the question of who really makes the money in self-storage gets an answer that is less obvious than it first appears. The tenant is not really the customer the business is optimized around. The tenant is the raw material. The real profit is captured by whoever can hold the asset through a full cycle without being forced to sell or refinance at the bottom, and that has increasingly meant scale operators and institutional capital rather than the independent owner-operator the industry's marketing still likes to picture. The bank that financed the original construction loan gets paid first, on a fixed schedule, regardless of whether the facility is 95% or 60% occupied, which means the bank's risk is not eliminated, but is placed ahead of the owners in the capital stack. The land underneath a well-located facility, particularly one in a dense or supply-constrained market, appreciates over time in a way that is completely disconnected from whether the storage business itself is thriving in any given quarter. That land value is a second business layered invisibly on top of the storage operation, and it is often the reason a facility that looks marginal on an operating basis is still worth owning, because the exit is as much a real estate sale as it is a sale of a cash-flowing business. Management companies collect their fee as a percentage of revenue, not of profit, which means they are paid even in a year when the owner's actual return has been wiped out by debt service and falling rates. And software and revenue management platforms, the systems that automate ECRI increases and dynamic pricing across thousands of units, have become a quiet but growing beneficiary of the entire model, since they are the infrastructure making the inertia monetization strategy possible at scale. The asset people notice, the row of orange or blue metal doors along the highway, is not actually the asset that creates most of the long-run value.
The building is the container, the pricing algorithm, the land underneath it, and the tenant's own reluctance to deal with a truck rental are the business. So, can owning a self-storage facility make you rich? For operators with the scale, the balance sheet, and the patience to survive a full supply cycle, rather than get caught financing a boom-era pro forma with debt that has to be refinanced at the bottom, the answer has historically been yes, and the margins on offer, even after the 2023 to 2025 correction, remain some of the best available anywhere in commercial real estate. For an individual owner who buys at the top of a construction wave, in a market where every competitor had the same idea at the same time, the answer can be closer to a multi-year lesson in the difference between gross revenue and cash left over after the bank is paid. The facility does not fail because people stop needing to store things. It fails because too many other owners noticed the same margins you did, at the same moment you did, and built their way into your market before either of you could see the wave of new supply coming. The units are still full of other people's procrastination. The question, in the end, is never really whether the storage gets rented. It is whether you built, financed, and timed your way into being one of the operators who gets to collect on that procrastination, or one of the operators who ends up subsidizing the tenant who never came back to clean out the unit.